Hello, I'm Matt Fettig, Chief Investment Officer at the San Diego Foundation, and welcome to the third quarter 2023 investment overview and results. It was a difficult quarter in a lot of ways. Recall that the first half of 2023 we had quite strong results out of the stock market, really led by what's now being called the Magnificent Seven. Seven stocks in the US, most of them with an AI angle, that really led and contributed almost all of the positive results that the market had in the first half. In the third quarter, things turned. Equity markets were down really across the board. That includes the US markets and the non-US markets. And at the same time, we had another interest rate increase by the Federal Reserve in July, and that really led to a spike in interest rates across the curve. A strong economy, inflation that still looked fairly robust and not slowing down as fast as most liked, and this interest rate hike caused rates to go up, and that ultimately led to bond prices falling. So as a result, the stock market's negative, bond market negative. There wasn't much of a place to hide during the third quarter. So let's start by talking about results from the endowment portfolio, of course through September 30th, 2023. For the third quarter, the portfolio was down 1.5%. The benchmark, our policy index, was down 1.3%. This was the second quarter out of the last 18 in which the endowment underperformed for the 1 quarter time period. So we have had a very good run of strong performance. Unfortunately, with the third quarter results having both the stock market and the bond market in negative territory hurt results. However, for the first time this calendar year, a lot of the other alternative investments added value. Hedge funds were up for the quarter. Real assets were up for the quarter. Private equity and credit produced relatively strong rates of return. So once again, having these diversifying asset classes does not add to performance every quarter, but it certainly did in the third quarter of 2023. Over longer term time periods, the 1 year, the 3 year, the 5 year, out to the 10 year, you can see that we have had relatively strong results against our policy index, and certainly the type of results we're looking for over long time periods. Next, we'll take a look at the long-term portfolio, $82.2 million as of September 30th, 2023. Also marginally underperformed the policy index for the last 3 months or 1 quarter. But you can see over the year-to-date period, and certainly over longer periods, 1, 3, 5, 7, and 10 years, relatively strong results versus the policy index. This portfolio consists 50% of equities, 20% of fixed income. So those diversifying strategies, which helped performance in the endowment, we just didn't have as many of those strategies here in the long-term bucket. Next, we'll look at the medium-term portfolio. Remember, this portfolio has about 25% exposure to stocks, 70% exposure to fixed income, and 5% exposure to real assets. So once again, some mild underperformance relative to the benchmark for the third quarter, but stronger results over the 1 year period. You can see over the 3 year period, slightly negative results for the quarter. Why did that happen? Well, if you recall, in 2022, throughout the entire calendar year, we faced a very strange environment in which both stocks and bonds were down double digits. That is a rare phenomenon to see. Typically, there is some negative correlation between stocks and bonds, particularly when stocks are doing poorly. But stocks were doing poorly last year because of this inflationary environment in which the Fed was quickly increasing short-term rates. The intermediate term portfolio down 1.7% for the quarter, trailing its policy index, but ahead over the year-to-date and one-year period. Remember, this is a fairly new portfolio we created. It is 100% fixed income. It has about 60% of its exposure to what we call core plus or intermediate grade fixed income, and the remainder in short-term fixed income. Our short-term portfolio consists entirely of money market funds. So as you can see here illustrated, this graph that shows performance, these are quarterly results, one quarter, then the next quarter, and so on. And what you see are no bars from June 21 to March 22. Why? Well, with short-term interest rates at zero during those time periods, there was effectively zero yield coming out of money market funds. Now, throughout the course of 2022 and into 2023, that has changed dramatically, with short-term rates up, driven by the Federal Reserve's interest rate hikes. You can see a lot of yield has come back to this portfolio. The sustainable endowment portfolio was off 5.2% for the quarter, trailing its policy benchmark. This portfolio has had a tougher go over the course of the last year. Remember, this is a relatively small portfolio. The sustainable endowment is at 10.1 million in total size. And if you look at the green portion of the pie, the global equity section, that is one investment manager managing that entire section of the portfolio. And unfortunately, they have pretty dramatically underperformed over the course of this year and into last year. We are in the process of likely replacing that equity manager with a new manager and hoping to get performance back on track with this portfolio. The sustainable non-endowment portfolio is really positioned the same way as the sustainable endowment portfolio. We have one manager managing the 73.7% you see here in global equity. That manager has underperformed. With just 14 million in this portfolio, it is hard to get a lot of manager diversification. However, we are in the process of replacing the manager managing the equity portion and hopeful to have better results in time periods to come. Thanks again for joining us today. Remember, you can always find more information at our website, sdfoundation.org. Thanks.